Jackie, and thank you for coming here.
Yeah,
so give her a warm welcome.
So it sounds like, and let me make sure I get this right, kind of nods around the room, a little bit about my background, my journey, and then a little bit more about the fundraising VC process. Does that kind of cover most of the topics that people are interested in? Cool. So what I'll do is I'll start with kind of my longer, short version of my background, so kind of how I got from U of I to where I am now. If you have questions, just interrupt me, and then I'll take a quick pause, see if there are questions along the way, maybe about certain experiences or transition points, and then we can kind of fully transition into the venture side of things, which I think people will probably have more specific questions on, and I can give an overview of what I do and kind of how we work with startups. Does that work for everyone? Okay, cool. So I graduated, I guess, over 5 years ago from engineering. I studied control systems. So I don't think they actually have general engineering anymore, but I studied control systems as a part of the general engineering degree. And as a part of that, I kind of learned that the technical piece of it was really, really exciting, and developing new systems was really exciting. But a lot of the jobs that were open to me coming out as an undergrad were a lot of like testing and tuning systems that other people designed. And I was like, well, that's not super interesting. I like the design portion. I have to go get my doctorate to do, any sort of like, space design, all the cool things that they talk about doing, you do in like lab settings during class. And I wasn't ready to commit to another couple of years of getting my PhD. I didn't know if that was what I wanted to do. So through the process, I ended up joining Accenture, which is a consulting company. A lot of people join consulting firms out of college and you don't know what else you want to do, and you just kind of want to start trying some different things out. And that's what I did. So a lot of times when you join sort of these big companies right out of school, and it sounds like most of you are not part of that trajectory, although you might end up there. Like anything that a back office does in a company, so finance, HR, supply chain, payroll, all these kind of complicated systems when you get at the scale of like a Fortune 500, right? And so I was working with companies that were buying other companies and had these massive technical systems and somehow had to mash them together or migrate the data from one to the other. Not super technically sophisticated stuff, but very logically intensive, right, from a technical standpoint. Like you're still using kind of, I'd say like the most coding I did was like SQL queries and things like that, right? So not super exciting from a technical perspective, but really, really good from a leadership perspective and exposure to upper management, that kind of thing. After a couple of years, I got a little bit bored with doing some of that like IT-based consulting, right? And we were kind of on the cusp of very, very large companies moving from on-premise systems to the cloud, right? And so the cloud is this big, sexy thing where you're like, all of a sudden we're going to have software in the cloud and it means something new, and everyone's scared of it because you're not in control of it. And then I realized like it's all just the same shitty software, right? And so during kind of that transition point, as we're helping companies move their stuff to the cloud and work through all the different challenges of that, I decided to look at different fields that I was interested in that I could either move to within Accenture or move to externally, right? So the things that I got really excited about were 3D printing and Internet of Things. I'm sure you guys work with a lot of 3D printing in your classes, especially like I'm sure Mechis, you guys do a lot of that. And then Internet of Things, whether or not you know that you're working with it, a lot of EEs, you're doing any sort of like signal processing, you're working in IoT. So these are both areas that are growing quickly, seem to match with my kind of more technical background, and started looking for opportunities there. I think a couple years into Accenture, I was recruited by a company called Silver Spring Networks, which is basically IoT for critical infrastructure. And it seemed to be a really, really good fit for me. Personally, I was really scared to kind of take the jump from a big company with a brand name and promotions on the way, that kind of thing, into a smaller, less established company, but one that had some interesting challenges. And so I decided to move. My role there was helping the company move from a utility-based company to utilities, smart cities, and other markets. So our technology was creating the network cards that went into devices, managing the network, and then some of the software up through an application layer. We worked with other software providers to gain insights from the information, all that kind of stuff. But basically the ability to manage assets in the field. And the technology we developed was really, really good for utilities, super reliable, leveraged a mesh network, so the resiliency was high, right? Like all these great things that were really, really good for city applications as well. So you can imagine streetlights, emergency systems, parking, they all kind of have the same thing. They're all assets that are outside, critical for operations, and have the same benefits of really being connected to the internet or being able to manage remotely. So I went there, started working on all these different product development. I was working with companies that were as small as, we typically worked with companies that were like Series A, Series B funded, but then all the way up to GE. So kind of like anyone we could get together to get more endpoints out in the field, because that's how we made money, was by deploying and managing all the different devices out in the field. So that was a really cool experience for me. Exposed me a little bit more to the whole entrepreneurial side of things, right? So I'm working with a bunch of CEOs who are trying to figure out how they can leverage us as a channel, right? Like you have a bigger company that's willing to take a step towards working with you, smaller company, but they're also worried about kind of wasting time with us, where if we don't get to a deployment or a customer sale or something like that, there are issues. So I was working with these big companies, small companies, everyone's kind of approaching it from a different angle. And it was a really exciting period of time. So I was doing that. I ran an incubator at Illinois Tech. Are you guys familiar with the, it's more of a technical university up in Chicago. We had an incubator there where we kind of just got to throw out a bunch of devices. It was private land, so we put up some non-UL tested devices, which you couldn't do in the city and other places. So it was kind of fun. But during that time, I was also going to school part-time to get my MBA. That's kind of why I asked what the MBA thing was. And it was at that point that I really learned about like what true entrepreneurship was and kind of the VC landscape, right? So unlike all of you, I know we have various, we have people that are various parts down the academic and career path, but I had no idea that venture capital was a thing when I was an undergrad, right? And so I got exposed to this thing, and I'm like, this is kind of amazing, right? There's a place where you get to work with really, really smart, ambitious, hardworking people. You are talking to people who are really on the cutting edge of technology business, right? Like that's what I had been trying to get to earlier in my career, is like always being kind of on the forefront. And a lot of you are working on things that are on the forefront, right, of whatever you're doing. You're either creating new technology, new business models, opening up opportunities, something like that, right? And that's really exciting. And then the third piece of it, which I had never had in another job before, was really a high level of impact and a direct correlation between kind of decision making and end results. And what I mean by that is when you work in a big enough company, unless you're at like the very top, any of the decisions you're making are either going to be like pretty good or great, right? Like all of you are smart people. You all obviously went to U of I. A lot of you seem to be doing, engineering, business, like really rigorous studies, right? In comparison to a lot of other folks, right? So the decisions that you're making are really like, I think this is a good decision. There might be a better option out there, but I'm going to implement this one. And then at the end, something good happens, right? It could have been much better if you were a little bit smarter, but you don't actually know, right? You're just not making terrible decisions that are sending companies spiraling downwards, right? And so what I really was missing was kind of this ability to say, this is what my opinion is, these are the actions I'm going to take, and then here's the outcome. And I have a measurable outcome, and you can kind of do a post-mortem too on the decisions you don't make or the actions you don't take, right? So I'll take a step back really quick and talk about venture capital. So venture capital is when you have a fund of pool of money, right? So we have investors They could just be wealthy individuals. They could be family offices that are really wealthy individuals, or someone like a pension fund or a retirement account that they all need to invest to get returns over time. And so we collect this pool of money and then deploy it into startups. Hyde Park, we invest in companies, early companies, so anyone who's doing less than $3 million a year in revenue, right? So everywhere from pre-revenue up through about that $3 million a year revenue standpoint. And those are typically called seed companies or Series A. It's on a little bit larger side of things. And the cool thing about being able to invest in companies at that stage is they either go out of business, they get acquired, or or they IPO, right? Like those are the three outcomes. Is nothing happens in a good way, or okay things happen, or great things happen, but they're all measurable, right? Like this company was sold or acquired for this much, this company IPO'd at this price, this company went out of business, right? And I think that is a really cool thing to be able to do, is say, I believe in this team that is building this product for these customers, right? And you take all of these guesses that are based on a small amount of information, right? Good public companies, you can have a lot of information coming from public companies, right? They give out quarterly reports, annual reports. Small startups, a lot of you work in them. How much information do you have about the actual operations of your company? Not a whole lot, right? You haven't been around for a long time. And so in venture capital, you have to take all these different pieces of information, make a decision, and then there's an output. And so that was all really exciting to me. I know I did a long ramble of why I got into venture capital, but those were the things that were exciting to me. And through some, I think, a lot of good luck, some hard work, I met the folks at Hyde Park, went through the interview process, and joined about 1.5 years ago. And since then, it's been great, and we can talk about a little bit more of what I do and kind of how we operate. But I'll pause there and ask if folks have any questions on kind of like the bio that I just went through. Okay.
The move from the consulting company to the next step, how did that happen? Whatever you can disclose.
Yeah, no, I can. So I decided that I wanted to get into the IoT field. I knew it wasn't going to be consumer, so I was kind of just looking at, people there's a lot of IoT movement in factories, out of factories. Logistics was getting to be big at that time, and so I really just started posting a lot of things on like LinkedIn and Twitter that were related to the field. And this is not like anything that's really exciting, but the company was expanding and they needed people, and it was a combination of showing interest in some sort of like thought leadership. I wasn't actually coming up with new ideas. I was just, interpreting the ideas that other people had. But that combined with the engineering background, because it's actually pretty complex technology, and having that background gets you up to speed a lot quicker than someone who doesn't have it. And then the MBA was kind of like a seal of, or like a stamp of approval for them. I hadn't even finished it at the time. It was just like on LinkedIn. So it was they recruited me. Is kind of the short story.
They proposed it, offered you a job, basically.
Yeah. And they were kind of like spitting up this incubator at the time, so it worked out well. Yeah. Anything? Yep.
How does your MBA experience impact the decision making you have so far?
Yeah. So I think actually I'm glad you asked that. So I think there's a lot of things that I learned in the MBA that I just didn't know were things that I could learn or that existed out in the world before then. And I know that there's a lot of opportunity now. I'm sure some of it was there when I was going to school, but I wasn't seeking it out to do a lot of like cross-disciplinary. For my major, we took like, it was probably like a 1-hour class that was project finance. So it was like basically how you do a discounted cash flow, you know, to see whether or not you wanted to do a project. I mean, that's probably pretty standard. Do they still teach that? Sort of. I'm getting like somewhat nods. So basically what you do when you have an engineering project that you want to implement, you say, how much is the project going to cost? How much will we gain in either savings or additional revenue? And you basically want to balance them off. If the cost is greater than what you're going to eventually make from implementing the project, then you don't do it. If the cost is less, then you do it. That's kind of like the short story. When we spent, you know, a semester, you know, kind of learning the basics of that. So that's all fine and good. There are two things that I think I get out of the MBA. One is a lot of the people management skills and awareness, which my first job out of college, I was very much with the mindset of do the best work and work the hardest, and the best things will come to you, right? Like that's how engineering really is too at school, right? If you work hard, if you work the most, you can generally get the best grades, right? Like you being intellectually smart, it gives you a certain amount of variance in engineering, but it doesn't give you the whole picture, right? And so I was very much of that mindset going into the MBA program, and kind of opening up my world to thinking outside of the work hard, get results box was really helpful. The other part of it is more just, I would say, intellectual curiosity that has been filled, which is like, really, how do the stock markets work? You know, certain things like that aren't super relevant to my job. Some more tactical things that you definitely don't need an MBA to learn, like accounting. Super relevant, right, for anyone who's in a startup. Like, you know, revenue, you know, basically like cost and revenue, like everyone should have a handle on. And then something that's really important to know is how you use cash flow. So I'm seeing some nods. This was something that I didn't really think about before, but you know, something that's so simple and I think trips up a lot of people who aren't thinking in advance about it is just because we're selling something for $10 and it costs us $5 doesn't mean we get $5 in hand right away, right? So I have to spend that $3 to get the raw materials, but I won't, you know, sell the product until 3 months later. So I'm out that $3 until, you know, I can sell the product. And that is actually why a lot of people raise venture capital, right? So if we think about, so what do you guys make? Are you the filter?
Yeah.
Okay, so you make filters. I'm gonna oversimplify what you do. Okay. So your company, and I'm gonna kind of use this to transition into VC. So if anyone has questions on my background, we can come back to it. But you create filters, right? And let's say they're made. What are they made of? Give you like a really simple thing.
Polymer.
Okay, they're made of polymer X, right? And there is someone in, where does polymer X come from?
Let's say from China.
From China. Good, you're making this simple for me. Okay, so polymer X comes from China, okay? And it costs us $10 to get enough material for one filter, right? And so we place the order to China, right? And we say we would like one polymer X, and they say that will be $10, please, right? And because they're a big manufacturer, they have terms that say you need to pay us this before we even create the product, right? Because you're this little startup, you're kind of risky, we don't actually know if you're going to pay. So you send us the $10 now, and then in a month we're going to send you polymer X, right? And then once you have polymer X, right, so that's a 1 month period, right, where you have to spend $10 without having any revenue. Then a month later you get polymer X, then you have to do something with polymer X to transform it into a filter, and then you have to hire a salesperson to sell polymer X to someone who needs the filter, and then 3 months later you have an order for polymer X filter, right? So everyone's seeing how that plays. So now we have, I can't even keep track of time, but let's say now we have 4 months between when we place the order for the materials and when we actually get the money for what we produced, right? So there's something happening there where you gotta have an extra $10 laying around right, to be able to do those expenditures before the revenue comes in. The other problem with startups, not problem, but the other challenge is that you have a whole team of people right now that are developing different processes, the core technology of how to transform polymer X into finished filter Y, right? And so you have all these salaries. I'm sure you have incredibly smart people working for you that need to be paid somewhat accordingly, right? They're taking a risk because it's a startup, but hopefully greater rewards in the end state. And so you have all of these people that are working on developing the product. You have the actual product that you have to buy, and then any sort of other overhead expenses of building or travel or just all the expenses that businesses have. And you have all these kind of cash outlays, but no cash coming in the door, right? And that's where venture capitalists come in. They say, look, we think you have a great product. Like, everyone needs these filters, right? Everyone. It's huge. We just got to get them to market. And so we say, well, how about we invest, $300,000, right? I'm assuming you're a seed stage company, right? A-round, sorry. Okay, so let's invest $4 million? Four? Okay, so let's invest $4 million. And you don't take more than you need. Let's invest $4 million, and in exchange, we'll own 25% of the company?
10%.
Okay, okay, let's say these polymers, these filters are incredible, right? And it is the hottest, fastest growing startup, so we'll give it to you for 10%, right? So that means the company right now is being valued at $40 million. Am I doing this math right? If I invested $4 million, I'm going to pretend no one else invested prior, okay? I invested $4 million for 10% of the company, so it would be $40 million is what the value of the company is. It's a pretty good valuation for a Series A company. And so that's where like venture capitalists come in, right? They say, here's some money, give us some equity. They probably try to be helpful, at least we do. Some are more helpful than others, with the idea that in 5 years.
3 to 5 years.
3 to 5 years, okay, that's pretty good. There is an acquisition, and that $40 million company will be eventually worth 400.
Just a good number. 400
million, right? And since we still own 10% of that 400 million, then we get 40 million, and you get the rest, right? And so that's kind of like the basics of why venture capitalists exist. Everyone with me so far? Any questions? If there are no questions, I'm just going to ramble.
I mean, you have a very difficult job of trying to. A startup is going to be kind of like another child for the founders. Mm-hmm. You're trying to lower the valuation to a degree compared to what they want. I mean,
sure.
They want 10% for $4 million.
Yeah, it's not right. I give
yeah.
up pretty easy. Is basically what you're saying.
Yeah.
Yeah.
But I mean, how do you convince? That's almost at times saying your child isn't the next. It's going to win Olympic gold medals in every medal in every category in the next Olympics.
Yeah. So you're asking like, how does the negotiation happen?
Yeah.
Okay. So there are a couple ways. Sometimes it's really, really easy. So for example, the last negotiation I was in or a part of was really, really easy. And it was basically we came to the table. We had been working with this company for a lot. I had done a lot on. We had invested in the company before. So Hyde Park, we invest in seed companies and Series A companies. So we'll write small checks, $100,000 into seed companies. And those are much more passive for us. So in this case, in the case that we were talking about, would have been more of a Series A, where we would have gotten more involved. So maybe I would sit on your board. If you needed intros to customers, we'd scan our network and see how to make those intros, right? We'd be much more active. So the scenario I'm talking about is a company that we had invested in the seed round. So we put a small check in had actually been pretty close and helpful with the entrepreneur, and then we were going to lead the series, or it was more of a post-seed round. But anyway, for practical purposes, Series A, right? And I think they were raising, 1.7 million or something like that. And so we both came into the room, everyone's friendly. We said, how about 5 million? And she said, how about 6 million? And we said, okay, let's make it 5.5. Easy, right? There are other ones where you actually have to figure out the value of the company. And it's a little bit more of a learned negotiation, right? Like another MBA class that is amazing is negotiations. So there are two ways to sort of value a company, and then another layer on top. So the two ways that you value a company are either by looking at similar companies, and so that's the way that we use it most often. And by that I mean, let's say your revenues right now are $1 million a year, right? We look at other filter companies and say their revenues are $10 million a year, but they're valued at $60 million. That's a 6x multiple on their revenues. So we would say, oh, that's a 6x multiple on your revenues, so that would be valued at $6 million or something like that. Okay, a little bit more complicated than that, but the theory is the same. The other way that you can value companies, and this is more relevant in like the public markets, and how there are all those analysts that are like, buy, sell, good company, bad company. Like they do much more in-depth financial review, and what they will do is project all of your future revenues, discount to them to the present, and figure out the enterprise value of your company. It's totally worthless doing that for startups because you don't know what your revenue is, you don't know what your expenses are, you don't know what your growth rate is. It's just kind of like, why bother? Like, why go through the mess? Because you know it's going to be 150% wrong. For public companies, it might be like 20% wrong, And so those are kind of the two ways that you bring data to the table and say, this is what the expectation should be. The layer on top that I was talking about is more on competitive dynamics, or like how hot the deal is, right? So let's say that you had sold your last company. You're like, I know how to build teams, I know how to go to market, I know how to negotiate, there's all these things I know how to do. And we would say, that's pretty good, right? That kind of brings the risk down of the company. And that also makes you a little more desirable as a CEO, right? Like everyone likes people who know what they're doing and a little more confidence. You probably have a team that you built before that you're gonna pull your best, the best people over to work for you again. So there are all these things that are making it a little bit more of an exciting investment opportunity. So let's say not only Hyde Park wants to get in the deal, but there's also Enterprise Works VC, right, that wants to get in the deal too. And so we come to the table and we're like, we will invest $4 million for 10% of your company, right? And let's say Enterprise Works is like, you know what, we really don't want to lose out. We'll give you $4 million for 5% of the company, right? In no way does that reflect the actual value of the company, right? It's just more competitive dynamics. Like we're already probably overpaying or overvaluing a little bit, and they're overvaluing by 2x what we are, right? And so that's more just based on competitive dynamics, and then it gets into a little more of a the entrepreneur can kind of use that as leverage to say, well, we have a term sheet for this. We would love to work with you, Hyde Park, but with these economics, it would just make sense. Like, can you do anything, right? And so it can go back and forth just from a pure like negotiations and kind of competitive dynamic. Most of the time, I will say that most of the time you want the negotiation to be, I'll say friendly, right? Like you can have a real negotiation, but you never want to have a negotiation where either party is really unhappy with the deal, right? Because when you take VC money, you're stuck with that VC until the company exits, right? Until it dies, is acquired, or IPOs, right? And even if it IPOs, maybe they stay on your board, right? You know. So anyway, you're stuck with these people for a long, long time. So price isn't the only thing that should factor into the decision to get involved with a VC. Make sense?
Thank you.
Okay. Yeah. Any other questions? I kind of. Yep.
When you say that the valuation of a startup can be 150% wrong, so how do you make correct investment decisions for funding really early stage startups?
I will say that a lot of times, okay, so let's pretend that I don't care about the valuation of a company. I just care about my fund, right? Funds have certain investment profiles that in theory should make them successful if the investments they make work. And by that I mean, we have I won't use 65 because it's a hard number, but let's say we have a $100 million fund, right? Our investors want like 3 times their money back, right? So at the end of 10 years or 12 years, they want us to return, 300 million, right? And there are other things that are a part of it. So there's something called carry, which is we get a portion of the profits that we generate. But for simplicity's sake, let's just say we deploy 100 million and they want 300 million back. We can go into some of the specifics later after this example. But to get that 300 million back, we have to invest in, let's say, 10 companies, right? So we invest $10 million in 10 companies, okay? Now, the law of startups is that, some people say a third, some people say half of them fail, right? You go to 0. So that's already 30 million that is worth 0 now. And then they say another third just kind of do okay. So that, let's say that next 30 million, I'm gonna have a hard time keeping track of this in my head. That next 30 million, let's say, is worth 100 million, right? So or let's say 40. We deploy 40 million across 4 companies, and then in aggregate, they return 100 million, right? So they all have pretty good outcomes, but not like explosive outcomes. And then the top third is where you get all of your returns. So let's say we deploy that 10 million into 3 different companies. We should get 200 million back from those 3 companies, right? So you're hoping that those companies go from having a $100 million valuation to a, $700 or $800 million valuation, let's say. And because of that, when you think about investing in companies, you have to own a certain amount of the company to make that happen, right? So I'll give you an example. Let's say I invested $10 million, or no, we were at 4 million, right? Let's say I invested $4 million in your company and I owe 10%. Then you sell for 500 million, I get 50 million back, right? That's not enough to really move the needle on my fund, right? I get 50 million, but really my investors want me to give them back 300 million, so that's like kind of one of those okay outcomes. What I really want to do is invest 4 million, 25% of the company, right? If I'm a $100 million fund, so that when you would exit for, let's say, $1 billion, I get 250 million back, and then that returns the fund, right? And so, in addition to all the things that I was talking about on valuing the company, there's also our own fund dynamics, which is I need to own enough of the pie. We need to own enough of the company so that when there is a successful exit, it actually means something. So for Hyde Park, some of the big coastal funds, right? There are these funds that have hundreds of millions of dollars in a single fund, right? And they need to own 20 to 30% of the company. They're also writing checks that are like $40 million, right? So someone's investing $40 million and they want to own, 20, 30% of the company. It's still pretty big companies. We aim to own, between like 8 and 12% of the company. And so in the example I was talking about earlier, let's say we own 3% to start, and then we invest more and more over time. Maybe we build our position to 8 or 9%, and that'll have an impact on our fund. Am I kind of getting there?
Yeah. So it's more of just knowing, you know, the risk percentage and investing to the proper percentage for each company that the returns make up for.
Exactly. Yeah, I can. I'm sure if you read Guy's blog post, I'm sure he has one on kind of the details of it. But there's both company and how the company should be valued, and then there's fund dynamics and what is meaningful to the fund. And when those things come together and everything makes sense, that's when the investment really happens. And you had, yeah?
Yeah, I kind of have a follow-up question. What is your expected return when you invest? For example, is that 3 times, will you consider a good investment, or is that 10% you would like? What is kind of that standard?
Yeah, so I think our investors, expect say 3 times from us, and so what then we in turn expect from the companies we invest in is the potential to return the fund. So the potential to do 10, 15, 20, 100x, right? We don't expect every company to return that much, but we expect these companies to have the potential to do that. And so that's another reason why, I talked about like things we like, right team, right market. You need a market. So the amount of people that will buy your stuff, you need to have enough of them to think that the company can be valued at a big enough number when it exits to really be meaningful. Does that answer your question?
Yeah.
Okay.
Typically, at what stage do you look at startups' financial projection and how much you typically discount on that?
So for me, different people will answer this in different ways. So I am someone who, like when I have a meeting with an entrepreneur, I much prefer to talk about the product, the technology. Like I'm much more someone who is
Product and team. Product and team.
Yeah, product and team oriented. I have an engineering mindset. I like that kind of stuff. So I spend, in a 30-minute call, I spend 20 minutes on, the background of the company, the founding of the company, the product, what the product does, and then, probably the, last 10 minutes on, okay, what is the revenue, what is your burn, like some of those more technical questions, and some of that is because I like it more, some of that's because I'm not as good at, pulling some people can look at a financial statement and can be like, what is wrong with that month, right? And I'm more someone who says, okay, talk me through your financial statements, right? What are the assumptions? How are you thinking about your team? How long are your sales cycles, right? How long does it take for you to sell the product? More of those things, and I would say at an early stage, the projections are much more of a reflection of the mindset of the entrepreneur than they are something to be held to. Once you make the investment, of course, and you set at board meetings, you should be hitting your projections more and more accurately, right? But when you're just looking at a company, you're saying, okay, this month we're going to make this much, next month, and in 3 years, 3 years from now, January, we're going to have revenues of, 600,000. No one believes that, right? Like, you're not actually going to, because if you grow faster, you grow faster. If you grow slower, it's more likely. But it's basically an exercise of saying, like, how are you thinking about growing your team? What's the sales process like? All those different underlying assumptions that go into creating a financial model. So that's more what I use those for. Make sense? Yeah.
What would you say the top 3 biggest mistakes startups make prior to seeking funding or during the process of seeking funding from VCs?
Yeah, so I think they're probably much easier. There are a lot of really, really dumb mistakes that people can make. And I think some of them are related to me personally, right? So when you go in to pitch a VC, a lot of times they don't look like me. So if you're condescending, if you don't ever email me back, but you go around my back and email apart, like there are all these like just simple courteous things you can do to not blow the deal, right? And I think what people don't realize is VCs are really small teams, right? There's like 5 people on my team, and we make the investment decision. And if I am, if I'm working on a deal and I really hate the deal, I'm not going to work as hard, And so you kind of have to know who your champions are in the team, and then everyone else you just should treat with the utmost respect, right? Everyone's a normal person, but there are very simple things that you would, you would not do in your own workplace that you probably shouldn't do to the VCs that you are pitching. And on the flip side of it is, if you are treating a VC in a certain way, it's almost indicative of how you treat other people, right? So I guess I'll give a couple examples. And I know this is not as insightful as you want it to be, but it's also just a reminder that, like, people are thinking about you, and if you blow them off, they'll think less highly of you. So there are kind of a couple examples that I can talk about. For me, me personally, I get turned off when people treat me like a secretary or an admin, right? Like, I think that's pretty simple, and just makes you a little bit less excited to be in the meeting. There are people who talk down to me, or kind of just treat you as not having, being capable of understanding what they're doing. I'm pretty smart. I can usually get there, even if I don't get there, as far as you would if you were actually creating the product, right? And then I would say there are some other things that have happened to, so those are things with me, right? Like, I'm obviously younger than a lot of people who are investing. I'm obviously female. A lot of those things kind of add up to a certain perception that can cloud people's judgments of who I am and kind of what role I hold at the firm. Other things like, not swearing at investors are good things that you should avoid. We recently pulled back, not that we put a term sheet out or a contract out, but we had been really excited about our company and found out that they had sent some really nasty texts with, whatever, curse words and things like that, and not just like the okay ones, but the ones you shouldn't say. And we had to be like, well, look, is this someone we want to work with, right? Like, if we make a decision they're not happy with, are we going to be left, on the receiving end of a bunch of FUs, right? Or is it, if you take it a level deeper, is this indicative of someone who kind of can't handle themselves under pressure, right? CEOs are under a lot of pressure. They have to make a lot of tough decisions. Their team turns to them. What if they crumble under bad news, right? And so you kind of have to think about those like baseline EQ things that are really, really good to have as a leader, right? And people are not just looking at you and your company and what you made, what you've done so far, what your potential is, but also who you are as people. Because at the early stages, you really don't have much, right? Like, you have an idea, probably a product, maybe a couple customers, but like talking like super early stage, you don't have much to go on. So it's a really big bet that these people are the people who are going to take this idea, this technology to the finish line, right?
So would you say that you almost put more value into the people in the startups?
I think it's equal weighting, definitely. I think it can be something that bumps you over, right? So like, if all the product stuff checks the box, but you're phenomenal, then we're gonna invest, right? And a lot of times that happens after like long-time relationship building, all of that kind of stuff, or previous success. So I know we've invested in even pre-product companies because we knew the CEO for a while. They had been an executive at another startup that had a successful exit. Like, we kept the relationship going, and those are kind of like easy yeses of, especially at the seed level when you're writing smaller checks, at least for our fund. Those are very easy things to get behind people and say, I know this person, you know, I trust they can build a team, I trust they can at least get to the next milestone. I think that's huge.
Thanks.